welcome back to the deep dive. If you're looking for the ultimate shortcut to really understand where institutional finance is heading, you are in the right place. Today, we have a pretty unique opportunity. We're doing a deep dive into the Q3 and Q4 2025 earnings calls for Goldman Sachs.
Right, and this gives us so much more than just numbers. It's really a strategic roadmap for one of the biggest financial institutions on the planet.
Exactly. So for you, the listener, this is all about getting strategic clarity.
That's the mission. We're going to pull out 3 specific threads. First, just verify the foundation. I mean, how strong was 2025, really?
Okay.
Second, we'll map out the core strategic pivot they've been making, shedding those non-core assets to focus their capital.
And
third, we're going to identify the major growth catalysts they're betting on for 2026. And that's where M&A and this big AI-driven efficiency push come in.
we are looking for the structural shifts here,
Yep.
the aha moments that show how a titan like this changes course and, where the big pools of institutional money are going to flow next.
Let's get into it.
Okay, let's unpack this. The 2025 scorecard, it looks incredibly strong.
It is.
They delivered full year earnings per share of, $51.32?
That's the number. And it's a huge 27% increase year over year.
That kind of growth, it really establishes a clear position of strength, doesn't it?
It does. And when you look deeper, the quality of those returns was excellent. You've got a full year return on equity of 15% and a return on assets of 16%.
Pretty solid.
But the real story here is the long game. Since 2020, firm-wide revenues have jumped by roughly 60%.
60%.
And crucially, earnings per share has soared an astonishing 144%. So this isn't just a cyclical blip. This is a multi-year trend of them getting more efficient.
That momentum is undeniable. But the context is critical here because they did all this while at the same time completing one of the biggest strategic cleanups in their recent history.
You're talking about the full exit from the consumer card programs.
Ex-
This is the pivot. We saw the GM credit card program transition finalized in August 2025. And then right after that, in January 2026, the agreement to transition the Apple Card portfolio.
Which were very high-profile consumer ventures.
Very.
It almost seems counterintuitive, though.
Yeah.
Why walk away from assets like that, especially when the underlying institutional performance is so robust?
It's a very deliberate strategy. It all centers on capital efficiency and their risk profile.
Okay.
These final card exits are just the visible part of a much broader multi-year shift.
Yeah.
The biggest move, the one that really strengthens their balance sheet, was the drastic reduction in historical principal investments.
So the riskier capital-intensive holdings.
Exactly. The stuff outside their core client services.
And how significant was that reduction?
Institutionally, just monumental. They reduced those principal investments by over 90%,
Wow.
taking the total down from roughly $64 billion to just $6 billion.
$64 billion down to $6 billion. I mean, that's not just a balance sheet move. That sounds like a culture change.
It is. It signals a fundamental commitment to being a scaled, high-margin institutional services provider, not a principal investor or a mass-market consumer lender. They are de-risking the foundation to fund the future.
So if the pivot is about risk and efficiency, where are they planting the seeds for, that high-octane growth
That takes us directly into global banking and markets, or GBM.
and their historical dominance in M&A?
Yes, we have to start with just the sheer scale of their advisory business. They've been the #1 M&A advisor for 23 consecutive years.
23 years.
And in 2025 alone, they advised on over $1.6 trillion in announced M&A volumes. That put them $250 billion ahead of their closest competitor.
That massive gap really shows how entrenched they are in the biggest, most complex deals.
Right. And that leadership positions them perfectly for the coming year. This is where it gets really strategic, because their outlook for 2026 is extremely constructive.
And they laid out some clear catalysts in the calls.
They did. The primary driver is a shift in corporate strategy. CEOs are moving beyond inflation and rate concerns, and they're focusing back on long-term positioning.
They're looking for scale, efficiency, and innovation.
And M&A is the vehicle for that strategic leap.
Let's pull on that innovation thread for a minute. When we talk about AI and M&A, the connection isn't always obvious. What's driving that?
Well, what's fascinating here is that the quickest way to get a proprietary edge in AI isn't always to build it yourself.
It's to buy it.
It's to buy the platform, buy the specialized team, or acquire the data sets that give you that competitive moat. So this need to acquire AI talent and tech is accelerating the M&A timeline in almost every sector. That's a huge deal catalyst.
And the second major catalyst is, well, it's just the pool of capital waiting to move.
Absolutely staggering.
Private capital sponsors have been sitting on truly incredible amounts of money.
We're talking about roughly $1 trillion in dry powder held by sponsors, and they have another $4 trillion in private equity assets in portfolios that need to be optimized or sold.
And that capital's starting to move.
It is. Sponsor activity was already tracking 40% higher year over year back in Q3 of 2025. So that reserve is starting to be deployed aggressively.
That confidence is quantifiable too. They noted the investment banking backlog hit its highest level in 4 years in Q4 2025. That speaks volumes about the pipeline.
It does, and that pipeline feeds what they call the M&A flywheel.
The flywheel. A single advisory mandate isn't just one deal.
Right, it's a multiplier effect across the entire franchise.
Can you give us an example of how that works? It's a great concept, but what does it actually look like?
Sure. Think about a major private equity client acquiring a large industrial company. First, Goldman provides the M&A advice.
Step 1.
Step 2, they immediately line up the acquisition financing and bridge loans. Third, if the deal involves international assets, they execute the currency hedging.
Okay, got it.
And finally, when the executives of the acquired company get their liquidity event, the Asset and Wealth Management division pitches them for wealth management services. So one deal generates activity across 4 different segments.
Which makes that M&A dominance less about bragging rights and more about a core engine for the whole bank.
Precisely. And while M&A is famously cyclical, they've also spent years building out the durable side of GBM.
You mean they're financing businesses within FIC and equities?
Exactly. That's critical for stability.
So how are those performing?
FIC and equities financing revenues hit a record $11.4 billion in 2025. And here's a structural change. These more stable financing revenues now make up 37% of the total FIC and equities revenues.
So it's becoming a much bigger piece of the pie.
And it's growing fast. Since 2021, those revenues have increased at a 17% compound annual growth rate. They're actively increasing the baseline stability of their markets business.
That structural stability is the perfect transition to asset and wealth management, or AWM.
Right, which they've positioned as the primary growth engine for the firm.
And they already have tremendous scale. I mean, $3.6 trillion in assets under supervision.
And they hit record durable revenues there in 2025. But what's fascinating is the ambition in their new targets. They aren't settling.
No, they are dramatically raising the bar for AWM.
They are. They've raised their pre-tax margin target to a very aggressive 30%. And they've introduced a new, really concrete goal for organic growth.
Which is?
A target of 5% long-term fee-based net inflows annually. That 5% goal signals they are driving hard for organic expansion, not just, relying on the market going up.
A huge part of that has to be the alternatives business, right? Which requires those massive long-term commitments from clients.
It's absolutely record-setting. They raised $115 billion in alternatives in 2025.
$115 billion.
Which substantially exceeded their own expectations. Because of that, they now think they can sustainably raise between $75 and $100 billion annually going forward.
And that sustainability is key to their long-term vision.
It is the foundation. They're projecting that their fee-paying alternative assets under supervision will reach $750 billion by 2030. That's a massive growth projection tied to those high-margin, sticky private market assets.
To make that happen, they've been extremely active with strategic partnerships and acquisitions.
A way to accelerate growth without building everything from scratch. We saw several key examples.
Like Industry Ventures.
Right. They acquired Industry Ventures, a leading venture capital platform that perfectly complements their secondaries franchise. And they also acquired Innovator.
A move to scale up their ETF business.
Quickly, to get into the top 10 active ETF providers globally.
And the collaboration with T. Rowe Price shows they are looking outside their own walls, too.
That's a crucial detail. That collaboration is designed to deliver a broad suite of solutions for retirement and wealth investors. All these moves are about building out the product engine to hit that 5% organic growth target.
Okay, finally, let's bring everything together. Efficiency, AI, and the external environment. They launched a new operating model, One Goldman Sachs 3.0, propelled by AI. Why now? Why undertake a massive efficiency mandate when earnings are already so strong?
That is the right question. The firm sees generative AI not just as a cost-cutting tool, but as a foundational lever for scale.
It's about creating capacity.
Exactly.
Yeah.
Freeing up that high-cost human capital from mundane, repetitive tasks so they can focus entirely on high-touch, growth-generating client work. It's about using tech to reimagine their processes no matter what the market is doing.
So this isn't just a corporate slogan. They've identified 6 initial work streams that are benefiting immediately from AI. What are those practical areas?
They're focusing on bottlenecks, so areas like sales enablement, speeding up pitch books, and client materials.
Okay.
It also covers client onboarding, lending processes, complex regulatory reporting, and vendor management. I mean, think about regulatory reporting. AI can analyze vast amounts of data almost instantly.
Turning a multi-day manual job into a near real-time process.
That's a massive efficiency gain, and it cuts down operational risk.
If we connect this to the bigger picture, it seems like the external regulatory environment is giving them some extra running room, too.
That is a huge, underappreciated tailwind. They are anticipating a much more constructive, more balanced regulatory environment through late 2025 and into 2026.
These terms can sound like jargon sometimes. What regulatory shifts are we actually talking about, and why do they matter?
We're talking about progress on things like SLR relief, which is the supplementary leverage ratio, GSIB recalibration.
The global systemically important bank.
Right, and the Basel III endgame. Put simply, the post-crisis rules that required them to hold huge amounts of capital are being reevaluated to better reflect the firm's current, much lower risk profile.
So what does that actually do for the bank?
It gives them clarity and flexibility. Because they are less systemically risky now, they shouldn't have to hold disproportionately high capital buffers. This regulatory unwinding improves their competitive positions significantly. It frees up capital that was just locked away.
And that clarity directly impacts their ability to return capital to shareholders.
Absolutely. They announced a significant commitment, including a 50% increase in the quarterly dividend, raising it to $4.50.
That's a big jump.
And management said that with greater clarity, especially around the stress capital buffer, they anticipate running with narrower capital buffers going forward. That capital can now be used for growth or return to shareholders.
So to synthesize our deep dive here, the entire story is really clear. They're de-risking the foundation, shedding non-core consumer assets,
Right.
while aggressively targeting that high-margin, scalable growth in AWM and leveraging their dominance in a strong M&A cycle.
And the whole strategy is underpinned by a powerful AI-driven efficiency mandate and these favorable regulatory tailwinds.
Which are providing extra capital capacity.
The synthesis is clear. The multi-year strategy has led to much better diversification and durability. They have structurally lifted the floor of their returns. They're positioned not just to benefit from a good cycle, but to maintain strong returns even if the external environment slows down. They've built resilience right into the model.
Which leaves us with a provocative thought for you to explore as you process all this, especially given that dual focus on technology and talent. The firm is so focused on automation and efficiency with modelGS 3.0, aiming to replace human effort with AI. Yet in 2025 alone, they got over 1.1 million applications from experienced hires. So they still need and can attract top human capital.
So the essential question for the coming years is this. How will financial institutions balance that urgent pursuit of AI productivity gains with the ongoing non-negotiable need for human talent in their premier franchises?
It's a real balancing act.
And when we look back in 5 years, what will be the true measure of success for this new era? Will it be revenue per employee, showing that they've maximized technology leverage? Or will it remain overall headcount growth, proving they can serve an even broader, more complex global client base?
Something to mull over as you digest these major strategic shifts. Thank you for joining us for the deep dive.